Very much, Kate. Comcast results are out. Adjusted earnings coming in at 76 cents a share. That was well above the consensus estimate of 59 cents. Revenue also beat forecasts. And guys, we report Comcast every quarter. Obviously, it's a parent company, and normally the earnings per share number is not as big a surprise. A lot of times it's free cash flow or EBITDA, and many times the strength in broadband offsets any weakness that you see in some of the other businesses, whether it's theme parks, whether it's not making movies during the pandemic. But in this case, that's a much better than expected bottom line number. And then there's a lot of other stuff in here. No doubt, things were some of these numbers reflect the difficult operating environment for theme parks, which I think were flat in terms of or break even. But once again, the broadband additions of new cable customers, the new additions, net much better than expected, even though I think that the video losses were worse than last year, and a pretty big number, something almost 500,000. So the cord cutting continues, but obviously with Peacock, big gains in Peacock subscribers, too. I was surprised at how many there were. I guess it helps if you don't need to pay for
42 million signups to date across the United States. And they're saying, the company's saying that's because of domestic streaming rights to the WWE network and The Office. But, Joe, when you look at the expectations here, it wasn't just the bottom line and the top line. They beat on free cash flow, too. They beat on adjusted earnings. They beat on adjusted EBITDA. Just about every metric, and a lot of the ones, if you look through some of the units, too. Cable revenue, adjusted EBITDA there, broadband and mobile ads. NBC Universal, adjusted EBITDA, they beat on. Sky revenue and adjusted EBITDA, customer relationship ads. So there's a lot of strong numbers here. This kind of fits with the trend of those companies that have been blowing out some of the earnings. And you mentioned the cord cutting, but at the same time, Xfinity Mobile did have its best quarter ever. They had 278,000 net line ads, and they reached break even for the first time since the launch.
Yeah, you can't look at it any other way than a reopening stock. Oh, this is like perfect for John Fort. But on the other hand, it's been unbelievable in terms of broadband additions and the strength of that business during the pandemic. So, I mean, it's got enough varied and sundry operations where it's both. It's both a pandemic, it's a stay-at-home and a reopening stock. I think you'd have, and how you balance it out, what's more important, I don't know. It looks pretty good so far. It's up about 1.5%. But isn't it? I mean, there's no way you can't say that they're reopen, because Hollywood's open, but Florida is not open?
Right. No, there's still it is a reopening stock. The question is whether you think there's what do you think? There's probably $4 to $5 in the reopen if you get to the reopen, right? Because those are the numbers. You're going to hit that. The question is that already built in? It was a great hedge. I would say this was a great hedge during the pandemic, more than anything else.
But you also need to make movies to put in theaters, right? You need to make movies to put in theaters. You need to make
to get it onto
content
streaming services and everywhere else. Yeah.
Right. Lucky they had things like
I'm surprised
that. Which we've been didn't matter. We don't need to shoot it on a set or
live throughout.
Right. We've been.
But the theme parks breaking even, I think, is pretty significant. That's, of course, excluding the Beijing reopening costs. But the revenue there was down 33%. So to be able to kind of take that as a non-loss on those issues, I think is pretty impressive, too.
Right. Now up almost 2%. So you'd have to, people pour through these things. But if anything was, the thing that people look for, once again, is the churn and the cord cutting and things like that. And that's out in front, and the company once again said we're not chasing people that are low margin, or customers that are low margin business. We're letting them go, and we'll look elsewhere. You can see how important streaming is to almost any company like a Comcast. So as traditional cable goes that way, and everybody's doing it. You look at Discovery and Disney or any of them, and that's. It's not a surprise where you're seeing a lot of resources deployed.
Shepard Smith here. Thanks for watching CNBC on YouTube.